Leverage. Leverage is a very interesting and important concept in financial management. The dictionary meaning of the word leverage is the exertion of force by means of a lever. When we have to move a big boulder with a crowbar or with a stick, we would like to exert a pressure by putting a small pebble below the crowbar or the stick, and the pressure will be the vertical pressure. Instead of pushing the boulder or the load, when we put this pressure, that's a very effortless, that results in the leverage. So the advantage of the fulcrum, well, it's something which is very much useful. It is the ease of doing something, doing the same thing with a lesser effort or an advantage. Simple advantage also can be the leverage. A small change in the effort leading to a greater efficiency by way of saving of energy or resulting in extra output. So that's what we can use it in the production. But in finance, it can be said to be an advantage or benefit or savings in the cost. It's the ability of a firm to use fixed cost assets or funds to increase the return to its equity shareholders. It results from the use of borrowed capital or an investment for expecting the profits made to be greater than the interest payable. In other words, leverage is the employment of fixed assets or funds for which a firm has to meet fixed costs or fixed rate of interest obligation, irrespective of the level of activities attained or level of operating profits earned. According to James Van Horne, leverage is the employment of an asset or funds which the firm pays a fixed cost or fixed return. The higher the degree of leverage, the higher is the risk involved in meeting the fixed payment obligations, that is operating fixed costs and cost of debt capital. Now let's see the types of leverage. Leverage, basically we have two types: financial leverage and operating leverage. Financial leverage. Financial leverage is primarily concerned with the financial activities which involve raising of funds from the sources from which the firm has to pay or bear fixed charges such as interest expenses, loan fees, etc. These sources include long-term debt, that's debentures or bonds, etc., and preference share capital too. These two facts led to the magnification of the rate of return on equity share capital and hence earnings per share. Thus, the effect of change in operating profits or EBIT on the earnings per share is shown by the financial leverage. Now, the formula of the financial leverage. Financial leverage is equal to contribution by operating profit. Contribution, if you remember, in costing, sales minus variable cost. Now, coming to the operating leverage. Operating leverage refers to the use of fixed operating costs such as depreciation, insurance of assets, repairs, maintenance, property taxes in the operations of a firm. Now, higher the proportion of fixed operating cost as compared to variable cost, higher is the operating leverage and vice versa. Operating leverage may be defined as the firm's ability to use fixed operating cost to magnify effects of changes in sales of its earnings before interest and taxes. However, it does not include the interest on debt capital. Now, the formula of the operating leverage: operating profit divided by earnings before tax will give us the operating leverage. Now, coming to the combined leverage. Combined leverage is a combination of operating as well as financial. So, financial leverage multiplied with operating leverage or vice versa. Now, in the formula form, we can simply put it as combined leverage is equal to contribution by EBT, earning before tax. Now, coming to the degree of financial leverage, DFL. Percentage change in the EPS divided by percentage change in the EBIT will give us degree of leverage, or EBIT divided by EBT. DOL, degree of operating leverage, is equal to contribution by EBIT or percentage change in EBIT divided by percentage change in sales. Thank you.